Welcome to Mad Money. Welcome to Cramerica. Other people make friends. I'm just trying to make you a little bit of money here. My job is not just to entertain, but to explain. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. The consumer cavalry got here just in time to give us what looks to be the beginning of a Santa Claus rally. That's the only way to describe what worked today. Everything involving consumer spending couldn't come at a better time because tech's been faltering. We needed something big to replace it. Even as you couldn't tell from the averages, Dow advancing 66 points, S&P jumping 0.79%, but the tech-laden NASDAQ surging 1.38%. Let me set the scene. For most of the year, we've had woe is the narrative consumer, right? I mean, consumer doing so poorly. Higher unemployment, true. Inflation kept the consumer on the sidelines. We kept thinking that they were just decelerating. Retail was pretty awful, except for Walmart, which powered through everything as CEO Doug McMillon moved to keep prices low. His own one-man war against inflation. A war I think he may have won before he's retired. We didn't see the weakness in the averages, though, even though the consumer represents two-thirds of the economy, because it was masked by the incredible run in technology, led by NVIDIA, but followed by Apple, Microsoft, Meta, Tesla, and most importantly, Alphabet. Behind the scenes lurked OpenAI, the creator of ChatGPT, which, along with Oracle, have been huge drivers of the burgeoning tech spend. For most of 2025, those are the stocks that drove the market higher, and that was the narrative we loved. Lately, though, skeptics have begun to challenge the notion of unlimited data spending. Oracle raised a huge amount of money in the bond market, $18 billion, but there's now a belief in the market that Oracle may not somehow be money good for the financing of this massive data center build-out, something it's doing largely on behalf of OpenAI. That's the private company. You can tell because people have been buying credit default swaps on Oracle's debt like crazy. Now, I do find that somewhat worrisome, I admit it. I am glad to hear tonight, though, according to the Wall Street Journal, that OpenAI is trying to raise $100 billion at an $830 billion valuation. That's up from $750 billion yesterday. Not bad, huh? If it can raise $100 billion at that valuation, well, then the company can keep building out data centers aggressively, and stocks like NVIDIA and Broadcom should be bought tomorrow. I, for one, though, am delighted that the attention for the day was away from the data center valuations because the artificial intelligence trade has become very hard to fathom, and Wall Street doesn't like hard-to-fathom valuations. So how did we start liking the rest of the market again? Was it just out of revulsion toward the AI trade? Well, somewhat, but it all starts with the consumer and what she has to pay. This morning, we saw a decline in the rate of inflation as measured by the Consumer Price Index. The core CPI, which excludes food and energy prices, fell to a 4-year low. Inflation had been eroding the consumer confidence and caused all sorts of consumer-related stocks to just get hammered. These numbers today show that inflation may have peaked, started to come down in a very positive way. So many different costs are indeed coming down. We can see that. We know gasoline's gone down sharply. Used car prices are down high single digits. All sorts of goods coming down to levels where they can move. And while it's not in the CPI, home prices, they are really coming down. We're going to have more on that when we talk about Lennar. But suffice it to say that the average selling price of some houses now below where they were in 2019. I thought that would never occur again. It's become a self-fulfilling world. If the Fed cuts rates, the consumer should spend even more. Hence why so many of these consumer stocks have been roaring since last week's Fed meeting. Of course, you got to ask yourself if the move is sustainable. I don't know, tonight Nike looks terrible, but that could be a lot of that is China. I think that the trend of lower prices, though, is just starting. Gasoline will struggle to rally given the glut in oil. That gives excess cash to the consumer who can spend it as she sees fit. Retail is such a huge portion of this economy, it can mask the questionable kinds of transactions we've been seeing at the highest level of tech. Consider the retail winner today. There's Darden, that's the owner of Olive Garden. It vaulted nearly 2%. Yes, the numbers from Olive Garden look great. Investment Club holding Texas Roadhouse gained 1.6%. Williams-Sonoma, we know how much we like those guys. Laura Albert, that gained 2%. Target edged up 0.46%. Kohl's finished up 1%. Look, you got to start somewhere. Let's not forget there's a lot of consumer in tech. Amazon, for example, is more than Amazon Web Services, even though Wall Street only seems to talk about that. Remember, they still have this e-commerce website that you're on every minute, and that's a huge, giant tailwind in this backdrop. So does YouTube and Waymo owner Alphabet. Apple might be hurt by higher memory prices from Micron, as we heard just last night. More on that later in the show. But a wealthier consumer may also buy more phones. Isn't it ironic that President Trump was railing last night about how Biden had left him with what was perhaps the worst inflation ever, when in reality it looks like the inflation story is coming down pretty quickly. The commodities themselves almost all have come down, except for cattle. If the president could give the cattlemen checks, we could take beef from Brazil and bring that price down, too. That's something that should be done. The Fed now seems justified in that last rate cut. The new Fed chief will have declining prices to allow even more room for easing rates. It's going the president's way. He seems to be so busy trashing his predecessor, he doesn't seem to realize when he's winning the war of inflation. Now, this whole market spent several years trying to get away from just owning tech. In the last few months, we've seen a tremendous broadening of this rally. The financials have been incredible of late. Citi's crushing is up 60% for the year. Goldman Sachs is up 53%. JP Morgan is rallied 31%. The autos have been getting stronger and stronger. Ford's up 35%. GM's gained 52%. Now it is retail turn, just in time for Santa Claus. The bottom line, the CPI number was terrific this morning. Consumer spending looks to be alive and well, and it's a huge win for the stock market. Best of all, it's a reminder that we can still rally big without tech, thank heavens. And when we get tech rallying and OpenAI gets its money, so that story's out of the way, it's going to be all the sweeter. Let's go to Dustin in Oklahoma. Dustin.
Booyah, Jimbo. Good to talk to you again, my friend.
Good to talk to you, Justin. Thank you for calling. How can I help?
Absolutely. We had a great game against my Chargers 2 weeks ago. I'm sorry it didn't work out, but that was a great game.
That's just one of many. One of many to come. Got a couple of people in the do not playlist I don't like, but go ahead. Let's go on.
Hey, you're awesome. Let's get to work. Jim, my portfolio is pretty tech heavy, as I've talked to you before. So I've been trying to diversify some into a large, very cyclical U.S. industrial. I got back into it about 3 months ago, but I find myself watching the headlines a little bit more because the earnings are still negative and the business is so sensitive to policy.
Yes.
A big part of the international demand seems tied to tariffs deals that are negotiated under Trump, and now the Supreme Court is reviewing the tariffs that could potentially impact those overseas fleet purchases. So given all that uncertainty, what's your long-term thoughts on Boeing still?
Okay, I'm glad you asked me about Boeing. It's a big position for my travel trust. I will tell you unequivocally that I think Boeing has bottomed. I thought the last quarter was terrific. People sold the stock down huge off it. Now it's coming all the way back, and that makes a lot of sense. I think that Kelly Ortberg is the person who should be been in running Boeing for years. He's doing that good a job. That's what I'm seeing. We've seen a tremendous broadening of this market over the last few months, and I think it's a reminder that we can still have a rally without tech, thank heavens. On Mad Money tonight, you called in and you stumped me on Enlight, so I hit the books on this company that specializes in laser technology, and I'm ready to give you my take on whether or not it's a buy at these levels. Then Lennar and KB Home both reported this week, and I'm homing in on the housing sector to see what's next for the cohort in 2026. And FedEx is on the move after the earnings crossed the tape, and I'm getting all the highlights from the company's CEO. So stay with Cramer.
Don't miss a second of Mad Money. Follow at Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Whenever you call to ask about a stock that I don't know, I put it to the side, do some homework, and come back with a more considered and informed opinion. Let's go to work. Back on December 2nd, Ed in New York asked me about a company called Enlight. Now, that's LASR, or laser for all you home gamers. As you can tell from the ticker, these guys make advanced laser products for aerospace and defense, industrial, and microfabrication applications. The company says it leads the world in high-power lasers for mission-critical defense systems and advanced manufacturing. Pretty sexy. Now, Enlight came public in April of 2018, and after a strong debut, the stock quickly fizzled. Its long-term trajectory isn't particularly inspiring either. It caught fire during the speculative mania of the COVID era, peaking at an all-time high of $46 in early 2021, but then it quickly pulled back hard from those highs before bottoming at $6.20 at the post-Liberation Day lows April. Wow. Since then, though, Enlight has caught fire, rallying roughly 480% in the last 8.5 months. to just under $36 today. This is one of the rare momentum stocks that's actually held up just fine over the past couple months. Why? Because Enlight's increasingly focused on the defense industry. There's a lot of laser business there. Initially, this company was focused on lasers for telecommunications. Then after the dot-com bubble burst, they shifted to industrial end markets. But in the last few years, they've been bet big on defense. And now Enlight gets more than 60% of its sales from the defense business. I got to tell you, when you purely look at what they're doing as a defense contractor, the story is actually very compelling. Enlight makes a lot of lasers that basically gather data, helping to identify and position objects, including missiles and drones. Most targeted weapon systems rely on this kind of technology. At the same time, these guys are working on so-called directed energy weapons. This is what I find most interesting. Actual lasers, like from a science fiction movie. This contract with the Pentagon was upsized to $171 million near the end of 2023. Of course, Enlight needs to keep winning contracts here, as that one should be finished next year. On the latest conference call back in November, CEO Scott Keeney sounded very confident about these directed energy programs because the Pentagon wants a laser that can shoot down drones. Inexpensive drones, expensive drones, go for the inexpensive, go for laser to stop the inexpensive. If you bet on the stock here, you're really betting that Enlight can keep winning this kind of business. And there are plenty of people who are willing to make that bet. Just yesterday, analysts at Roth Capital initiated coverage on Enlight with a buy rating and a $44 price target, precisely because they believe in this business. I have no idea whether the technology makes sense, but it sure seems like the Defense Department is willing to spend money on it, which might be all that matters. Now, there's one thing that's been nagging at me with this one, and it's a simple fact that Enlight doesn't have a great tracker when it comes to, making money. The company hasn't been profitable for the last 3 full years, and perhaps worse, its sales peaked way back in 2021 before declining each of the past 3 years, falling from $270 million in 2021 to under $200 million last year. When you look at those numbers, it's no wonder Enlight stock sunk to an all-time low earlier this year. But most of that historical weakness was caused by a combination of poor performance from Enlight's industrial business and the fact that the company had to ramp up spending in order to build the types of directed energy weapons that the Defense Department wants. Plus, this year, their financials have improved significantly. The year started poorly, with Enlight pre-announcing weak results in early January, and the full results for that quarter were bad, too, when they came out in February. But in May, Enlight surprised to the upside, a nice revenue beat and a smaller-than-expected earnings loss for the quarter, plus strong guidance for next quarter. In August, Enlight reported even better numbers with another top-line beat and a surprise profit, plus, again, very robust guidance for the next quarter. And that's why the stock jumped 28% in response to the quarter. When the company turned in its latest numbers in early November, they delivered another excellent quarter. The story is entirely now about aerospace and defense growth at this point. That end market was up 50% in the latest quarter and accounted for 68% of total revenue. Now, just so you know how important this is, the other two end markets were both down double digits, so we could de-emphasize those. According to the full-year consensus estimates, Enlight should put up 29% revenue growth and return to profitability. On top of that, analysts who cover this thing expect the numbers to keep improving for the next few years. Nice. So where do I ultimately come down on Enlight? When I saw the stock's tremendous gains and noticed that the company was focused on laser guns, I was worried that this might be another year of magical investing stock. But after looking into the story in depth, this is a real established company with a legitimate business that has great potential in the future of warfare. The stock's been roaring this year because it should be. The numbers have gotten better and better. Plus, it's very encouraging to me that Enlight stock has held up so well, right as so many of the other year of magical investing names have fallen by the wayside. That said, considering how much the stock has run, I find it very hard to recommend this one up here. Right now, Enlight's selling for roughly 80 times its 27, not 6, 27 earnings estimates. It was just pretty rich, especially for the out years. Also, and this is more instinct than science, I'm a bit worried that while Enlight might not be a year of magical investing stock, it certainly traveled with many of those names and could get hurt by a broader cool-off in momentum stocks, and these keep happening. So far it hasn't happened. But if momentum names keep getting hit, this one might cool down too. So here's the bottom line. I wouldn't put new money to work in Enlight at these levels, given how much the stock's run. If you already own it, I say sell enough shares to cover your cost basis so that you're playing with the house's money. If you don't own it and you like the story, I recommend waiting for a pullback, which seems highly likely to me at some point. But if the pullback comes and Enlight keeps putting up good numbers, then you better believe I'd be a buyer. Mad Money's back in from the break.
Coming up, are home building stocks headed for a big finish to 2025? Cramer's deconstructing the latest key earnings numbers to find out. Next.
We're starting to wind down for the year, but there's still some big reports coming from industries that are real battlegrounds. Take the home builders. On Tuesday night, we heard from Lennar, and then after the close today, we heard from KB Home. This is a group that Wall Street's wanted to like for a long time. The iShares U.S. Home Construction ETF, that's called the ITB, rallied more than 40% from early April to its highs in early September, mostly in anticipation of another round of the Fed rate cuts from the Fed. But now those rate cuts are here, and the situation is not playing out the way the bulls hoped. See, long-term rates, the ones set by the bond market that actually control the cost of your mortgage, they haven't really played ball. The 30-year Treasury currently has a 4.8% yield, which is down from around 5% at its highs, but not by much. It's actually been trending higher since mid-October. With only a little bit of support from lower rates, the home builders just rolled over in September and kept falling until mid-November, before finally catching a bid once we started to believe that the Fed would bless us with another rate cut at this December meeting. Now that rate cut has also come and gone, and the builders as a group have lacked clear direction this month. That's why I wanted to see what Lennar and KB Homes had to say this week about what they're actually seeing on the ground. What did we learn? Long story short, the builders are still not particularly well. So if you're inclined to bet on them, you're wagering that things will improve substantially in 2026, and it's not clear that that's going to happen. Let's start with Lennar. Turned in a technically mixed but mostly bad set of numbers on Tuesday night. The good news, deliveries came in better than expected, up 4% year over year. Total revenues also surprised to the upside, although they still declined 6% from the previous year. That's not good. Within the core home building segment, revenues and average sales price both exceeded expectations, even as they represented declines of 7% and 10% respectively. The bad news, the most important thing, profitability, or the lack thereof. Lennar's home building gross margin came in at 17.0%. That was down over 500 basis points year over year and well below expectations. I always look at gross margins when I do home builders. That's my number one metric. Home building operating earnings were down 52% year over year, much worse than expected. And Lennar only earned $2.03 per share. Wall Street was looking for $2.26. That's an almost 50% decline year over year. That's not good. It gets worse. With every quarter, Lennar also gives us some more forward-looking metrics, and those painted a pretty discouraging picture. New orders, they came in lower than expected. The average sales price for new orders was in line with expectations. That's good, but still below the average selling prices for deliveries this past quarter. And it was down huge year over year. Lennar's guidance for the current quarter, weak. Company expects to deliver 17,000, 18,000 homes in the current quarter, well below the 20,089 number that Wall Street was looking for. That was shocking to me. Management says the average sales price for these homes will be between $365,000 and $375,000, and they're talking about a home building gross margin coming in between 15 and 16%. Both of those represent deterioration for the quarter they just reported. How about their full-year forecast for 2026? Lennar's guidance for deliveries was also weaker than expected. Man. Now, Lennar's been pretty transparent about its strategy. They're focused on keeping volumes up, and they're willing to make sacrifices on price and incentives in order to keep moving lots of inventory. Admirable, but their strategy comes with a big hit to profitability. Worse, when you look at the new orders numbers and the forward guidance, it doesn't seem to be working. Even with Lennar giving buyers great deals, demand still seems to be softening. And you understand, these guys are fantastic at what they do. So this was shocking to me. This morning, two different analysts, and someone else was shocked too, RBC Capital and Evercore ISI, they downgraded Lennar to an underperform rating. Sell. RBC Capital's Mike Dahl wrote, quote, "We are downgrading Lennar to underperform from sector perform following a weak fourth quarter and first quarter guide with the fiscal year 26 guide and expectations around a recovery in margin later this year still presenting risk to 26 earnings. While numbers may have reset yet again, there is no quick fix to margin headwinds in an affordability-constrained, soft consumer environment," end quote. That's a tough assessment, but it's hard to disagree unless interest rates come down much faster than almost anyone's expecting. All right, how about KB Home? Smaller, but it reported after the close. They also had a disappointing set of numbers. Like Lennar, they did beat on some lines for the reported quarter. Homes delivered and revenues were both slightly ahead of expectations, even as they fell 9% and 15% respectively. I told you this group is very difficult. Adjusted earnings per share beat expectations too, even as it fell 24% from the year-ago period. But average selling price was down 7% and missed expectations. Home building gross margins were down nearly 400 basis points. What did I tell you? That's the key metric. Fell well short of the street's expectations. And KB Home's home building operating income fell 49% and came in well short of the consensus estimates. Like Lennar, KB Home's forward-looking metrics look, well, like the new orders, they're weak. And its outlook for both the current quarter and the year ahead was far below what analysts were looking for. So it's no surprise that KB shares are lower in after trading. I told you this groups from hunger. So what should you make of these updates from the home builders this week, especially that disappointing result from Lennar, one of the most important home builders in America? Honestly, it's a pretty discouraging picture. On yesterday morning's conference call, CEO Stuart Miller, he's the dean of the whole home building industry, said matter-of-factly, quote, the current housing market is entrenched in an affordability crisis, end quote. He even found his way to talking about socialism and capitalism for a minute. You know, something's a real problem here. When the CEO of a large capitalization home builder seems to be sharing talking points with the socialist mayor-elect of New York City. In my opinion, Miller sounded a little befuddled by how long it's taken to get the housing market back on its feet. Lennar has already cut its prices a great deal at this point. Lennar's average selling price on an annual basis peaked at $480,000 in fiscal 2022. Keep that number in mind. $480,000. In the past 12 quarters, we've seen a steady decline in average sales price through the $400,000 level down to the $380,000s in the past couple of quarters. That's real deflation. And now, remember, they're now talking about $365,000 to $375,000 per house average sale price for the deliveries in the current quarter. So this chart will keep going lower for the time being. These are lower than pre-COVID numbers were. Remember how housing had gone up 40% from its low and everyone was worried about the price of a home? Extraordinary how much home prices have come down from the COVID spike. Extraordinary. Ultimately, Miller said he believes that Lennar can, quote, keep the volumes moving, and, quote, this strategy he thinks is the correct one. We will find our floor and rebuild our margins as the overall housing market continues to remain short on supply, end quote. But you know what? After this week, you got to wonder how low that floor might actually be. A lot of investors and analysts are deciding that they don't want to stick around to find out, and I don't blame them. The bottom line at the end of the day, you don't need to be a hero in the housing space. If you want to make a bet on a turnaround for the builders, I think you should start small for now and wait for a clear sign that the buyers are returning before you make any big bets. And we are most certainly not there yet. Let's take some calls. Let's go to John in New Jersey. John.
Hey, Jim, thank you so much for taking my call. Super long-time listener, former club member. Got to jump back in there at some point, but appreciate everything that you do. My question...
And I hope you come back. Go ahead. I'm sorry.
Will do. Absolutely. I'll have some more time on my hands. So my question is on Anywhere Real Estate Advisors, symbol HOUS, HOUS.
You know what? I know that I know those guys because my wife sold real estate. I don't want to be in that group. I think that you really need a much hotter market to be able to justify being in that. I'm going to take a pass. It just doesn't seem right for me right now. All right, look, if you want to bet on a turnaround for the home builders, I suggest you start small, wait for a clear sign business is picking up. I wish I could be more encouraging. I happen to like the management of these companies very much. Mad Money, it's much more Mad Money ahead, including my sit-down with FedEx. Now, finally, there's a quarter for you. The global shipping giant is often seen as a bellwether for the economy, and I'm getting a read on where it might be headed next in my post-earnings exclusive with the company's top brass. And the narrative is switching. It's going to be more business to business. That's where the real money is. Then I'm breaking down Micron's blowout earnings report to see what I think about what it's setting the standard for business and what should be done in the tech space. And, of course, all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer. You look at these numbers from FedEx. At the close, the freight powerhouse reported a truly strong quarter with higher than expected revenues and a 70-cent earnings beat off $4.12 basis. Even better, management raised the low end of their full-year forecast for both revenue and earnings. This company spent years trying to cut costs and optimize its delivery network. Clearly, those efforts are paying off. And even though the freight division came in a little weaker than expected, that business has been struggling for a while now, and FedEx plans to spin it off next year. So let's take a close look with Raj Subramanian. He is the president and CEO of FedEx. To learn more, Mr. Subramanian, welcome back to Mad Money.
Hey, Jim, thank you for having me on your show. And I'm just delighted about this quarter. You know, we grew revenues 7% and bottom line 17%. And despite trying circumstances, I'm just shout out to the entire FedEx team who delivered these results.
Well, it's very clear that this is the kind of quarter that we've been looking for FedEx. The stock did run up in anticipation because I think people just understood that a lot of what you're doing, the cost-cutting programs, the longer-term really kind of like what you did with healthcare, which is obviously winning. You are starting to win one by one in the verticals. Tell us where you are in terms of taking share from everybody else.
Well, I think, first of all, as you said, we put in place a structural cost reduction program. We took $4 billion out in the last 3 years, and we have $1 billion target for this year, and we are on track for that. But I think the most important thing for this quarter was the revenue growth story. And we are, as you can imagine, FedEx is the heartbeat of the industrial economy. That's the global network that we have put in place. Our focus is always on differentiation and providing new value for our customers. So we are winning in key verticals, whether it's healthcare, whether it's aerospace, whether it's defense, and now the newly minted data center, and the AI investments. So this is a very strong quarter for us because we have been putting these plans in place for some time, but now the team is really executing, and I'm just really proud of that, proud of our teams.
All right, let's talk about the AI investment, in particular for your company. If I went to some of your more modern warehouses, would I see people or I just see robots?
Well, I think from our perspective, if you go to the newer hubs, you will see that there's this huge building that packages go through that facility in a matter of minutes with all machines. But there are, we have truck loading and truck unloading that is manual, and there are robotic solutions being built for that as well. But I was referring also to supporting customers who are investing in data centers. And when they talk about these, billions and billions of dollars of investments, that means they have to move these parts around the world. And we are in full support of that as well.
Well, go over that with me, because I know that for a data center, there literally can be hundreds of thousands of parts. I never really had an idea how they got there. They're going through FedEx.
Oh, well, we're part of the solution, obviously. These things are moving within the country. They're moving cross-border. And as our network, as we have built it over 52 years, this is in place now to move anything, any product from any one part of the world to any other part of the world, and moving through customs clearance, moving through borders, those kind of things. So we provide a unique solution for that business. And as the investment grows in this space, that translates to more B2B business for FedEx.
Okay, I was just going to go there. I was thinking, I'm listening to this man. Raj is saying to me, he's not talking about Christmas. He's not talking about holidays. That's B2C. That's a hard business. And the margins aren't that good. B2B, the margins are great. Where are you in some sort of transformation? We'll be thinking of FedEx as a B2B business that also happens to work for consumers.
100%, because the network that we have built over the last 52 years is really reflective of the high value supply chains in the world. We are the heartbeat of the industrial economy. And of course, we can provide services on B2C on that platform. Obviously, we've seen significant growth on B2C as well. So, that's been a more prominent feature in the last few years in terms of what people are thinking about FedEx. But ultimately, FedEx is 66% of our revenue comes from B2B.
Okay, that's really, look, I would have, before you told me that, 2 years ago even, I would have said, all right, well, tell me how Black Friday was. Maybe, will Black Friday ever be an afterthought where you'll make good money, but you won't take your eye off the prize of business to business?
Well, we'll never take our eye off the ball for B2B. We have a very, very dedicated focus to support our B2B customers. I was just in our Memphis hub just 2 nights ago, and we put into place specific services that move our healthcare customers, for example. However, having said that, we are also, big in the B2C side of the house. We are having a very good peak. We're just right alongside of the forecast that we thought it's going to be. And it's going to be a high single-digit year-over-year growth for peak. We got 1 more week to go, so I'm not counting it all till it's all finished. But despite Mother Nature being a little bit finicky this month, our teams have done a tremendous job.
Well, if I were the Federal Reserve Chairman, I would say, well, wait a second. Everyone tells me I should cut rates, but these guys are growing at a high single digit. How do you figure why your business has far exceeded what the GDP growth is right now?
Well, I think we are executing at a very, very high level. We are undergoing 3 different transformations at the same time. The first is a networks transformation, both domestic and international. We're going through an organizational transformation with one FedEx, removing all the silos that existed before. And we're also going through a digital transformation. With all this, we are executing at a very, very high level, and I think that's part of the story. It's too early for me to say how much of it is market and how much of it is FedEx.
Now, what are we thinking Drive? What are we thinking Tricolor? What are we thinking about how much money you're saving?
Well, I think for example, from a structural cost perspective, like I said, we removed about $4 billion in the last 3 years. Our target was $1 billion for this year. We are right on track for that. We are halfway through this fiscal year, and we are more than halfway to that target. So that's going great. the tricolor network has been absolutely fantastic, especially in this current trading environment. That provides us the flexibility and the precision and the resilience in this environment. And I think that's what's paid real dividends, especially as the trading patterns have shifted dramatically in the external environment.
Okay, so tell me about where Europe is compared to where it was 5 years ago.
Well, I think we are very pleased with our progress in Europe. It all started with service, and that's when about a few quarters ago, we had some challenges that we had to fix, technological challenges. We fixed that. We fixed our service. That translated into revenue growth, which translated into profit improvement. Having said that, we have a long way to go here. And so there's a significant upside for us to generate in Europe. We have put in, it's primarily 80% of the businesses in Europe is a ground-based business. Right. So we have now moved some of the top management from our ground business or the legacy FedEx ground into Europe, and that's paid huge dividends. So while I'm pleased with the progress, but we have significant upside ahead.
Okay, let's go China. You probably know China because your business council work better than anybody. Where are we? What are we doing with tariffs? How are we feeling about it? Can it ever be a growth business again?
Well, I think for, the supply chain patterns and trade patterns are changing. We're going from one equilibrium state that has been in place for 30 years or so to another, and we're right in the middle of that transition. China to the United States has declined significantly in the last 6 months, and we have flexed down our capacity significantly accordingly. However, as you've seen probably reports, China's trade surplus is actually up, right, meaning that there's more traffic going to other parts of the world. So our intra-Asia traffic is up, or Asia to Europe, which is primarily B2B actually, is up. And Latin America inbound is up. Asia to Middle East and India is up. India outbound is up. So these patterns are changing. The fact that we already have a scale network globally in place, and the fact that we have intelligence on high-value supply chains coming from the bottom up, allows us to move with precision and agility, and that's what's helping us in this environment.
Has reshoring helped you? I know that when you talk about Eli Lilly, for instance, putting up billions of dollars worth of plants, that's healthcare, that's you. Mexico, largest trading partner, that's you. Yes. Fill us in about the new U.S. and what it looks like for FedEx.
Yeah, no, this is the point I was trying to make, because when we have our scale network in place, we are here, there, and everywhere. And that's what allows us to, if the traffic's moving from Mexico to the United States, obviously that's a big opportunity for us. And we are now, making moves all around the world. For example, we have direct flight launch from U.S. to Singapore connection, for example. We have launched a flight out of Dublin, out of Riyadh, for example. We opened facilities in Bangalore in India. We opened facilities in Istanbul. This has all happened in the last 6 months. So we're moving with pace. And we, as I said, we have the intelligence of what's happening from the bottom up, and we can move with velocity here to cater to the demands.
All right, last question. How are we looking in terms of new planes versus old planes? I mean, MD-11, got some planes that people don't even know what they look like anymore.
Yeah, I think, firstly, our thoughts go out to the folks at UPS because this is a terrible tragedy of the MD-11, and we offer all support there. And, our fleet modernization program started in 2012. In fact, our age of our fleet now is younger than our competition because of the modernization program that they've been through. We have, we've done a terrific job of managing the MD-11s. I was in the hangar on Tuesday night, and we got a phenomenal team of aircraft technicians dealing with the MD-11. We are waiting on with what NTSB and what FAA are going to give us a protocol, and we're ready to execute and get those planes back in the air.
Well, congratulations on a great quarter. I hope the rest of the B2C goes very well. It's B2B is in my heart because I know that's for big money, but you got to do both, and you do a great job. That's Raj Subramanian, President and CEO of FedEx. Thanks for coming on the show, Raj. Really appreciate it.
Thank you, Jim. I appreciate it very much.
Okay, Mad Money's back after the break.
Coming up, Cramer takes your calls, and the sky's the limit. It's a fast-fire lightning round. Next.
It is time. It's time for the lightning round. Remember, back for only the same stocks started buy, sell, such a core stock question. Tell my staff, play the sound. And then the lightning round is over. Are you ready? Ski Daddy, time for the lightning round. Let's go to Sam in Pennsylvania. Sam.
Jim, how are you?
All right, how are you doing?
Good. Jim, last week we had a big acquisition of a cybersecurity company by ServiceNow. I'm talking about Armis for $7 billion. So it caught my attention because 10-1001 has been long on my radar. So I'm curious what you think about 10-1001.
No, I don't think it's a good. It has been at various times, I understand, shopped and didn't get a bid. You got to stick with the high-quality ones. Got to stick with CrowdStrike or Palo Alto Networks, both owned by the trust. Let's go to Harlan in Washington. Harlan.
Hey, Jim. Listen, this Kura, K-U-R-A, Oncology, their first recent U.S. sale triggered a $135 million
Yeah, that's a lot.
Milestone
that is a lot.
Payment.
And then now, just understand that they are milestone payments, not actual. Now, here's what you have to understand. I have always felt that if you have something that is for cancer and it works, then you have to own the stock as a speculation, but just as a speculation because it's been such a difficult disease. J&J and Merck are the ones that are ahead if you want the majors. Let's go to Sean in New York. Sean.
Hey, Jim. How you doing?
I'm doing well. How about you, Sean?
Syracuse, New York.
Booyah. What's up?
Yes, I had a question on a stock. I saw an interview on the network there about 3 months ago.
Okay.
And it was pretty convincing. The stock I was asking about is BMNR.
Yeah, Bitmine immersion. Okay, now I think this is part of that year of magical investing that I'm telling you I think is over. And I don't want you in anything that's involved in the year of magical investing. Let's steer clear of that. I want to go to Dave in Illinois. Dave.
Dr. Cramer, my mad Trinidadian tarpon angler. How are you?
Indeed. Boy, I'll tell you, those things really pack a wallop. What's going on, Dave? What's happening in Chicago? Well, or suburbs.
Jim.
Go ahead. Yeah.
Yeah, Jim, several months ago, you labeled this like a mini NVIDIA, with earnings growth rivaling NVIDIA's. Up over 100% on the year. Jim, please update your thoughts on Credo Technology.
No, Credo's a winner. There's a lot of insider selling in that one. But no, we think that Credo has one of the great growth stories, and I'm not going to back away from it. Look, this is right now, people hate what's inside the data center. But there is good business being done inside the data center, and just because we haven't figured out how all the financing is going to happen, Dave, Credo still works for me. Let's go to Jim in New York. Jim.
Jimmy Chill.
Yo.
This is Jimmy R. I wanted to send you a big holiday booyah from Schenectady, New York.
Excellent.
Yes.
What's going on?
Hey, I'm a first-time caller, long-time listener. I made some money about 20 or 25 years ago on a stock, and then saw the stock come into favor again recently. I bought a bunch, sold it for like a 65% return, and now it's inside of an IRA rollover. I want to buy it back. So I'm wondering about Sienna.
It has moved a great deal. That was an amazing quarter. I think it was so great. The next quarter is going to be great too. I'm not going to fight you on it because this Sienna is much better than the Sienna of 2000, when a lot of us lost money in the first 3 months of the year, if you remember that. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, Cramer's putting Micron under the microscope to see how the chip manufacturer has taken off and whether it's time for you to get on board. Next.
Yes, it makes sense for Micron, the dean of memory chips, to blow away the estimates and see its stock fly 10% today. This may be the second largest beat I've ever seen, only behind the monster quarter that NVIDIA put up 2 years ago. It was magnificent. But you must realize that as great as this is, there's a very simple reason for Micron's strength. Demand overwhelms supply, just like Act 10. As CEO Sanjay Mehrotra told me, quote, "We are only able to meet 50% to two-thirds of demand from several key customers," end quote. The stock didn't go down even as it advanced almost 250% from its April lows coming to the print, because Sanjay said that tightness in memory chips should persist beyond 2026. The kinds of chips Micron makes used to be considered plain humdrum, just commodities even. Not anymore. The chips are in such short supply that the value of memory, especially the high bandwidth memory that Micron specializes in, is higher than ever before. He's already talking about substantial records for revenues, gross margins, earnings per share, and free cash flow for next quarter and several quarters after that. Look, there have been many times when Micron's had more demand than it can handle in the 30 years I've been following the company. This time seems much more lasting because there are extreme shortages for all the machines Micron would need to expand its production capacity. And that's why the stocks of Applied Materials, KLA, and most importantly, Lam Research, the companies Micron needs to build capacity, all roared too. But the rest of tech took its cue from Micron and broke the recent downtrend, even though the supply-demand situation for most of these companies quite different from Micron. For instance, let's say two of my favorites, Broadcom and NVIDIA, both which are up today. They simply do not have the same situation at all. Micron has its own manufacturing facilities, meaning it makes the stuff itself. NVIDIA and Broadcom are what's known as fabless companies. They make their chips through Taiwan Semi. That's who actually does the manufacturing. If demand overwhelms supply, it's Taiwan Semi's problem. That's why even though Micron's crying about demand, it doesn't exactly translate to Broadcom and NVIDIA, unlike Western Digital and Seagate, which are basically in the same kind of business as Micron, albeit with less intellectual property. I go into this level of detail because the Micron portion of the semiconductor world is a world that actually makes sense to me. You have a good chip. People buy the chip. It's in short supply. You raise the price. You make money. However, that's not how it seems to be working for some of the hyperscalers these days, especially for a company called OpenAI. This company, which is the pioneer in the AI group, needs tremendous accelerator computing power in order to work efficiently. Meta, Google, Microsoft, and Amazon all use NVIDIA chips. They pay NVIDIA out of cash flow. It hurts, but they do it. OpenAI doesn't have enough money to pay outright, but companies want their business so badly, they come up with novel ways to make it happen. Some companies literally seem to be buying their business by investing in OpenAI with the presumption that OpenAI spends that money on their products. Some think it's just going to be a great buy to get in there. I don't know. It's very different from the Micron situation, which is a lot cleaner. Like I told you at the top of the show, I'm mistrustful of these kinds of deals. I wish the vendors would just insist on actual payment, because when I saw these kinds of deals at the end of the dot-com era, and I was involved with that as a business person, they often misled you into thinking that some companies are doing better than they really were. It was a sign of weakness, not strength. Micron, on the other hand, is the way business should be done. Micron's not paying anyone to take their stuff. There's just so much demand of these memory chips that they can't possibly make enough of them. They're trying hard to allocate what they can give to customers. In the end, that makes me like Micron a lot more than some of these other companies that have an air of desperation around them. I'm a simple guy. I don't want to stake in a company that wants my products because I have no idea what that stake might ultimately be worth. I want to be paid with cash in the barrelhead. Micron's a cash machine. When in doubt, you know what? You always go with cash. The other methods may come back to bite you, even if you, like me, think the world of the chip companies that are actually doing the selling to these hyperscalers. I like shares always. Bull market summer. I promise I'll fight just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.